In the past 15 years, investors have been through 2 recessions and 2 sharp downturns in the stock market. These 15 years have been a true test of endurance. Retired folks have had to cope with lower returns than they expected, and many have had to cut back on their spending. Younger investors have seen their savings accumulate at a much slower pace than in the past. Baby boomers have been particularly disappointed by these 15 years. After all, they lived through the previous 15 years of booming markets. What about the next 15 years? Are investors going to be burdened by a new normal of lower returns? That's a question that is haunting many investors. Let's review the past 15 years, first in terms of the U.S. stock market. You can see that there have been 2 steep declines in the S&P, followed by prolonged rallies. By the end of the 15-year period, the market is definitely higher than it was in 1999. But what a roller coaster ride. The last collapse of the market in 2007-2008 during the financial crisis was particularly unnerving. Over the past 15 years, U.S. stocks have had absolutely no equity premium. In fact, stocks have underperformed bonds by 0.5% per year on average, with stocks earning only 4.7% per year. Over these 15 years, the poor performance of U.S. stocks was matched by the stocks of the foreign industrial countries. But emerging market stocks did much better, earning over 11% per year over this period. REITs also outperformed with a 10.4% return. So in an otherwise disappointing 15-year period, a little diversification helped. By the way, these 15-year averages hide a lot of variation over time. In 2013, when the S&P was earning an incredible return of 32.4%, emerging market stocks and REITs both had really mediocre returns. Let's consider how a younger investor would have fared during this period. I assume that this investor is far enough from retirement to invest only 25% of the portfolio in bonds. 40% of the portfolio is invested in U.S. stocks and 25% in foreign stocks, including 10% in the stocks of emerging markets. Why is so much invested overseas? I think the proper answer is, why not? Why confine the stock portfolio to companies that happen to be headquartered in the United States? Why should the portfolio be dependent only on the U.S. economy? To further diversify the portfolio, 10% is invested in the REIT market. I'm assuming that this investor is not wealthy enough to invest in fancy alternative investments like private equity or venture capital or direct investments in real estate. The REIT market allows this investor to own a portfolio of diversified commercial real estate indirectly. In this 15-year period of mediocre returns, how much could a younger investor have accumulated? Let's imagine that this investor started with $100,000 at the end of 1998. If this sum was invested in a tax-deferred account, it would have grown to $276,000 by the end of 2013. But that's a little misleading because the cost of living rose over this 15-year period. Inflation, in fact, averaged 2.4% per year since the start of '99. Adjusting for this inflation, the investor's wealth grew from $100,000 to $194,000 by the end of 2013, almost doubling the investor's money. That's not bad for such a period of relatively low returns. Older investors have been disappointed by returns over the last 15 years. That's because they were spoiled by the abnormally high returns earned in the preceding 15 years. These 15 years started in 1984 and include the boom years under President Reagan following the recession at the beginning of the 80s. And it also includes most of the NASDAQ boom period under President Clinton. Over this 15-year period from 84 to 98, stocks earned an average return of 17.9%, or 14.2% after taking into account inflation. Bonds earned an average return of 10.3%, or 6.8% in real terms. If an investor had started with $100,000 in '84, it would have grown into a princely sum. Let's follow this $100,000 over the next 30 years to try to imagine how lucky the baby boomers were. How much wealth would have been accumulated during this period? Adjusting for inflation, the $100,000 would have grown into $1.08 million by the end of 2013. Baby boomers were quite fortunate to have worked and saved during such an incredible period of stock and bond returns. But let's look ahead at the next 15 years. What can an investor expect to see? Many investors are worried that returns will not be as high as in the past. In particular, investors are haunted by the notion that a new normal of lower returns lies ahead. Bill Gross introduced the new normal in May of 2009. He predicted that we were in for a prolonged period of lower stock returns because growth in the industrial countries was likely to slow down. We might have to get used to a 301k account instead of a 401k. I believe the reason why the new normal idea caught on as much as it did is because investors are already worried that the recession had done permanent damage to the economy. Let me point out that Bill Gross chose a bad time to introduce the new normal. We are about to embark on a classic stock market rally that has lasted over 5 years. This should not have been a surprise because we always have a stock market rally at the end of a recession. Let's look at the rallies following the last 9 recessions, going back to the early 1950s. The chart shows the S&P 500 return in the 12 months after the market reaches bottom. In the latest rally, for instance, the market rose almost 50% in the 12 months starting in March of 2009. By the way, knowing that the market rallies after a recession is not a recipe for market timing. First, the rally almost always starts before the end of the recession, at a time when investors least expect a rally. In 2009, for example, the market rallied in early March, just 6 months after Lehman Brothers failed. Second, it's very difficult to know when a recession is going to end. The last recession ended in June 2009, but few people at the time believed that this was indeed the case. It was many months before we knew for sure that the recession had ended. In any case, if you bought into the new normal too soon, your portfolio would have missed out on one of the greatest stock rallies of all time. Yet Bill Gross may be right that stock returns in the future may not be as high as in the past. Future stock returns may not be as high because growth in the industrial country has slowed down. One reason for slower growth is that the financial crisis has had lingering effects on the availability of credit, especially bank lending. But another reason for slower growth is that population is aging in many countries. In Japan and Germany in particular, the working age population has already started to decline. Consider the growth of GDP in several industrial countries since the end of the recession at the end of 2007. U.S. GDP fell over 4% before beginning to recover in 2009. Today, output is about 7% larger than at its previous peak. That's not much of an achievement after 5 years of recovery. The pace of recovery falls far short of those of previous recessions, such as the deep recession suffered in 81 and 82. Even so, the recovery of U.S. GDP certainly looks much better than those of Japan and Britain. GDP in both of these countries is barely back where it was in late 2007. Growth in the euro area also has been disappointing. Germany's economy has grown about 5% since late 2007, but Italy's economy is still depressed, as is Spain's. The Italian economy is 8% smaller than it was at the end of 2007. The slow pace of recovery is reinforcing concerns about a new normal taking hold. Yet, let me point out some counter-evidence, particularly about the U.S. economy. First, the U.S. remains the center of innovation in the world. Startups are the norm rather than the exception. It's not just social media. Even the taxi industry is undergoing a revolution. Second, the U.S. actually celebrates entrepreneurs, unlike some countries that chase them away. That's why so many young foreigners want to come to this country, perhaps to start new businesses. Third, we are in the midst of a new energy boom, 155 years after the first discoveries of oil in Pennsylvania. Cheap energy has lowered the cost of manufacturing, so manufacturing is starting to shift back here. In the meantime, growth should stay rapid in many emerging markets. It's true that Chinese growth has slowed down from its earlier pace of 10% or more, but 7% or 8% growth is still impressive. The other BRICS have had some troubles recently, particularly Brazil and Russia, but other emerging markets such as Poland and Mexico have kept growing, and there are hopeful signs that India's new government will turn things around. Look at how different Colombia and Peru look today compared with a dozen years ago. Even Africa is starting to grow again. In any case, you never know which markets are going to outperform. That's the lesson of the last 4 decades. The chart shows the annual returns in 4 different markets: the US, the European and Pacific portions of the EFA index, and the emerging markets. The emerging market data, by the way, only began in the 90s. Notice how leadership changes from decade to decade. In the 70s and 80s, the Pacific region led in returns, followed by Europe. In the 1990s, the US economy took the lead, followed by Europe, with emerging markets way behind the United States. In the period since, it's been emerging markets that have earned the highest returns. For investors who insist on staying at home in the United States, note that the US market led the pack in only one of these decades, the 1990s. I worry more about a new normal for bonds than for stocks. We are at or near the end of a 30-year bull market for bonds. It's been wonderful, but it's going to end soon. What lies ahead for bond returns? Let's consider 2 opposite scenarios. Interest rates stay low. In that case, bond returns are going to stay low and way below the long-run averages that we have enjoyed in the last 60 years or over the last 90 years. Over both periods, the long-run average return on bonds has been about 2.5% adjusted for inflation. If interest rates stay low, that's unlikely in the near future. The second scenario is worse. It's that interest rates rise. In that case, bond returns will be even lower, at least during the period when rates rise. Now, I'm going to leave it to the Fed watchers to tell us whether interest rates will start rising, if they're going to start rising, when they'll start rising, and by how much. But as investors, we should expect that bond returns will disappoint us. That is, a new normal for bonds seems easier to predict than a new normal for stocks. Let's turn to the baby boomers and ask how they should be invested. I still believe in a 50-50 portfolio for those nearing retirement or entering retirement. Why should a retiree include stocks in the portfolio? The reason is that Americans are increasingly living long lives after retiring. Those retiring at the full retirement age of 66 have an average life expectancy of about 20 years, a little bit more for women, a little less for men. There must be some growth in the portfolio if this money, this retirement money, is to last a lifetime. But I also believe that retirees must diversify their stock portfolio. That means a portfolio with foreign stocks and real estate in addition to the U.S. stocks that have traditionally been favored by many retired Americans. How would this portfolio have fared in the past? The table reports returns on this portfolio over the last 30 years starting in '84 and the last 15 years ending in 2013. All returns are adjusted for inflation. Over the full 30-year period, a 50-50 portfolio would have earned 7.2% returns, adjusted for inflation. That's more than enough to sustain a 4% spending rule in retirement. Over the last 15 years, however, the returns are only 4.2%, and those returns ignore investment fees as well as taxes. No wonder retirees have been complaining about their lot. Retirees were particularly distressed by the financial crisis and the resulting recession. So let's focus on how this portfolio performed during the crisis. Let's begin with $1 million invested 50-50 in stocks and bonds at the beginning of the period. Consider first the case where the investor is not yet retired. The $1 million drops by almost 30% in early 2009. But if the portfolio is left alone, it recovers all of its value. And by the end of 2013, it is up by 30%. On the other hand, if the investor is already retired and drawing 4% from the portfolio, the recovery is definitely not as dramatic. In that case, the portfolio is still down by the end of 2013, but it's down by only 4%. That in itself is quite an achievement. Remember that we experienced the worst financial crisis since the Great Depression, and retirees emerged from this crisis with their wealth largely intact. This was the ultimate test of the portfolio approach to investing. Sticking with a diversified portfolio really does work. The true danger during this period lies with the investor himself or herself. If investors panic during the crisis, their portfolio will never be the same. Consider the case of an investor who pulled out of the market in the spring of 2009, when conditions seemed so dire. Today, the portfolio would be 40% below its original value. For the rest of retirement, spending would have to be curtailed by 40%. That's the ultimate cost of panicking and changing the portfolio. Whether the new normal prevails or not, investors need to renew their focus on saving and investing. For younger investors, consistent saving at 15 or 20% of income remains the surest way to reach retirement goals. Max out the 401k at work. That's the easiest way to build up a retirement portfolio. For young and old alike, choose a diversified portfolio of stocks and bonds and stick to it. That's the lesson of the Great Recession that we've been through. For the retired investor, the 4% rule may be too rich, but rather than focus on whether that rule has to be amended, be sure to keep investing as disciplined as possible. That's what worked even in this recent distressful period. All of this is discussed in my new book, Investing for a Lifetime. Thank you for listening.